I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
We're chatting to Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
Jim, thanks again for having me.
Now we can hear ducks in the background. Where are you talking to us from?
That was my text going off. I silenced the phone.
Okay, I thought you were talking to us from some beautiful backroom garden with a duck pond.
No. That was just someone texting me with a question.
Tim, you had some really interesting news for me. Since July last year, China has dumped 38% of their equity holdings in the U.S. What does that translate out as? Well,
in a technical sense, I found that article pretty interesting in that last July is when we were set up and the market rolled over, and we saw the triggering of the primary bearish trend change in accordance with Dow theory, I should say. And so, that fits nicely. I mean, it makes sense. And quite honestly, you have to wonder with that sort of a liquidation if that's not what caused the Dow theory primary bearish trend change in effect. I mean, it certainly weighed on the market, and it happened in that same timing, provided that this article is accurate, and I have no reason to think that it's not. I mean, I don't know. But I do find it coincidental that that is the exact timing of when everything fell in place. And then we all remember what happened into August of last year, and now we've had two recoveries since then, which has served to pretty much put everybody to sleep. And I think, as I have been saying for months, it's the same old story, but it is what it is. It hasn't changed. The complacency is very, very high because of these two counter-trend rallies that we've had since that setup. But nothing has changed with that setup. It's in place, and consequently, we're left hanging, but the risk is still there. It's still very, very risky market.
I've heard that institutional investors have now taken out most of their money in the U.S. equity markets, yet somehow the numbers have been growing. Who is putting their money in?
I don't know. I have no idea about that. I see some strange behavior that I can't explain, but in spite of that strange behavior, like I said, the higher degree setup is still there, and because of that, and a number of things, because of that, and the degree of or I should say the extension, the degree of the extension of this cycle, and the underlying statistics and all of it, the whole thing, it just creates a very, very, very risky stock market environment. I mean, and I've said that before that this is the most dangerous stock market environment since the inception of the averages in 1896. Yet we hang here, and I stand by those comments because we are dealing with the most extended 4-year cycle ever. We are dealing with a financial experiment to keep things going in spite of, the underlying economy, in spite of the underlying technicals, in spite of the underlying statistics. And here we are. I mean, it's the same old song and dance. I can't help that. But those risks are still there, and I maintain that this is a very, very, very delicate situation with the market and extremely risky.
Has a wrench been thrown into the works by Europe and Japan introducing negative interest rates? Because in all of recorded human history, we've never had negative interest rates.
Well, it's just another of the tools or efforts to extend and manipulate. I think when all of this started, the thinking probably was that, we can provide a Band-Aid and it'll heal and the market will pick up and the economy and things will be okay and off we go and we can avoid the little downturn, the recession, and everything will be fine. We just bridge it, if you will. We don't have the little dip with what we needed to have with the downturn of the cycle. Well, that didn't work. And the underlying economy has continued to deteriorate. Nothing has changed. Like I said, look at the job participation rate. I've even heard Trump talking about that. That gotten enormous attention. I've talked about that for several years. You look at the overall volume characteristics of the market. That hasn't changed. You look at, any of those underlying statistical or technical factors, none of it's changed. Just like the Dow theory non-confirmation, none of that's changed. It's still there. And so all this has done is extend the inevitable. They just continue to extend and extend and extend. And if we look at history, like I said, what makes it so dangerous is that there's no one time. I don't mean to sound like a smart aleck, but give me one example. Give me one example of where any market in history has ever been manipulated and extended and it worked. There's not one. Ever. And this one will be no different. And when we came out of the 2002 four-year cycle low, they extended that one, extended again, trying to provide that Band-Aid, and they stretched, at that time, what was the longest extension of a four-year cycle ever, and it ended badly. It created the worst financial crisis since the Great Depression. Well, now we come out of that bottom that inevitably happened, and that inevitably happened in accordance with the statistics, I should say, and here we are now in an even more extended environment, which was extended due to the same processes that extended the last one. It's a disaster. The fact that we're holding, and the fact that everybody's complacent and asleep at the wheel, in my opinion, just makes it that much worse.
Last August 24th, we had a major correction in the markets. Then to start off the new year, January and February, another big decline. Will those look like country picnics compared to what is facing us probably late this summer, early this fall?
In accordance with the statistics, absolutely. It absolutely. And that is why we see the continued efforts to hold things, because I think they know how dangerous this is and what the consequences are going to be. And you'd rather put it off if you can. So, kick the can down the road, as they say. But like I said, there's not one example. It just doesn't exist. There's no time in history that anything like this has worked. It's only made it worse. So, I guess not in summary, but again, all of these factors are still there. Nothing has changed.
Should we not be misled by what happens in the stock market? I remember once an anchorman saying on the evening news, "Oh, look, the numbers on the Dow are way up. That must mean the economy is doing well." Are those numbers terrifically misleading?
I think when we had, and this is just my thought without any great research on this, but I think obviously when we had a free market, that the numbers on the averages was probably somewhat reflective of the underlying economy. You think about it. Coming out of World War II into the 50s and the 60s, the entire world was prosperous from I wasn't born in the 50s, but into the 60s and 70s, I remember, and even into the 80s. We all remember that. And yeah, that was a prosperous time. I think that the stock market numbers were probably reflective of those times, of the underlying economy. I think it was real. But since 2000, no. I maintain that the secular bull market, the true organic secular bull market, and I know this is a hard concept to grasp, but it's in the letters, it's laid out, it's just pretty much black and white fact when you look at the data. But the secular bull market peaked in 2000. Everything we have seen since then has been a manipulated attempt, like I said, to provide that bridge, that Band-Aid to keep things going, hoping the economy would pick up, that it would and get going, to rekindle the animal spirits, as they say. Cutting of the interest rates, and the process, like I said, with the last 4-year cycle, it created the commodity bubble, the housing bubble, and look how that ended. And this time, it's all in the equities, basically, and even more extended, and it has not worked. So, no, I don't think that the numbers today are reflective of anything realistic.
The first time I can really recall of markets being manipulated or someone trying to manipulate them was in the 70s, when the Hunt brothers tried to buy all the silver they could to corner the silver market, and for a brief period they really did boost silver prices, but even that manipulation after a while fell apart. Is that the same kind of scenario we're going to see now?
Absolutely. That's what the statistics tell us. And there's so many examples of that. And like I said, name one. Just one. You can't. It doesn't, you cannot defeat the natural ebb and flow of these cycles. It's like the old commercial. It's not nice to mess with Mother Nature. It has to ebb and flow. And extending these cycles, yes, they can do it. And maybe this thing levitates another week, a day, a month, 6 months, or 2 years. I don't know. But the setup is there and the risk is there. And I think once it gets going, then there will be no stopping it. I think the environment is perfect for that too, in the sense that people have been become, I should say, very complacent with these last two rallies. And so, in August, people kind of spooked a little bit. People felt a little of the fear. Well, these last two rallies have put that pretty much to rest. I mean, I don't know anybody that's afraid of the market decline here or senses the risk or anything like that. So, I think the boat's loaded on one side, which I feel like, looking at it psychologically, creates an environment for a stampede if there is a surprise to the market. So, again, that's why I think that we're dealing with or another factor in the reasons why I think we're dealing with one of the most dangerous environments since 1896.
And if you'd like to meet Tim's challenge, you can email your proof that he's wrong about the markets at info@howstreet.com. We'll have more with Tim Cyclesman Wood right after the break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Tim Cyclesman Wood. During the break, we were talking about efforts to manipulate the market, like the Hunt brothers' effort to boost the price of silver so they could make a killing, and how that turned out, and how, when these prices go up so often, the consumer doesn't get to enjoy the decrease. Because I remember dentists charging a lot more for silver fillings because the price of silver was going up, but I never saw them drop their prices when the price of silver dropped by 80-90%. Airline prices only went down 2% when the price of fuel went down. In fact, some airlines continued to give you a fuel surcharge on top of your ticket price on flights to Europe. So consumers seem to always be the losers when there's a manipulation that goes on. Is that the case today, Tim?
I think so. I was just noticing the very same thing on some shipments that I did. You know, freight. We saw freight fuel surcharges on fuel surcharges, I should say, on freight when price of fuel started going up several years ago, and they have not been removed. We saw that on electricity. That has not been removed. So you're right. The consumer is always, you know, everything rolls downhill to the consumer, and he pays. Ultimately, and it's gonna, like I said, it's gonna be the same way with the market.
And of course, I think the ultimate betrayal of the consumer was income tax was introduced for the first time during the First World War to help pay for it. Well, apparently we're still paying for the First World War because I haven't seen income tax removed.
Now that you mention it, neither have I.
Tim, with this uncertainty, though, in the equity markets, can we expect the price of gold to continue to go up? I noticed that it's at one of its highest prices in the past couple of years.
It is. Gold has, you know, back in 2011, we can digress just a little bit. You know, it made the 9-year cycle top. And I've maintained all throughout the period since then that any rally would be counter trend and that it would ultimately go lower and that we would work lower into 2016-17 for the 9-year cycle low. And, you know, we saw the rally out of the December low and it did pretty well. And then we saw a decline into late May, and now we've had this rally into June. And, you know, gold is sniffing something. And when I say sniffing something, it's sniffing, I think, the problems, the trouble on the landscape. And from that perspective, yeah, I think gold is seeing the 9-year cycle low or setting up for the 9-year cycle low. But Jim, I don't have the data yet to say that low's in place. I mean, there should be another push down, another at least retest of that December low. And I have to maintain that until I see evidence that that's not the case. But I do think gold is in the process of making that longer term bottom. I just don't think we're there yet. I think it's going to come with one more push. I'm going to stick with that because that's what the data is telling me still.
I've seen two very divergent opinions on the price of crude oil. One predicting $60, $70 oil. Another saying in the next 4 months it's going to drop perhaps all the way back down into the 20s. What's your prediction on this?
Yeah, I tend to agree with the lower price. I think that we're fishing for an intermediate degree top if we haven't already seen it, and that crude oil is got another trip back down as well. I have to agree with that. In fact, I think that we're setting up, at least what the tea leaves are telling me at this point, is that we're setting up pretty much for all asset classes to go down into that period. You know, equities, oil, commodities in general, gold, and you know, into the end of the year, early next year type thing with another push down. Absolutely. That's what I'm seeing at this point.
Tim, thank you so much for chatting with us.
Yes, sir.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. You can find us on Twitter at Talk Digital Net or check out our popular YouTube channel, Talk Digital Network. Questions for the show can be sent to info@HowStreet.com, especially if you can meet Tim's challenge. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.